Okay, for this video, I want to go over the IRS Form 1099-A and cover a scenario where you have to report this information on your tax return. So there are a lot of instances where you don't have to really do anything, but in this case, I'm going to show you an example where you need to report something. So I've got the sample 1099-A in front of us. This was a foreclosure of a piece of real estate investment by the taxpayer. And so during 2022, the bank took it back and sold it, and they issued John this 1099-A. So I've got the 1099-A here. I do have a worksheet for foreclosures and repossessions. So this is pulled from the publication 4681. And this is necessary in order to calculate the gain or loss that you realize once the bank takes the property back. Okay, so I've got those two pieces, and then I do have a sample tax return here, a 1040 for 2022. And we'll go through this and see how John needed to report everything on his tax filings. And then the last one here is 2 slides. So I have the fact pattern that we're going to be working with itself. And then I do have 1 slide here covering some background on the 1099-A and some instances where you might receive it and when you might need to report something on your tax return. So firstly, what is the 1099-A and who must file it? So the who must file instructions provided in the 1099-A and 1099-C instructions provide that this has to be filed by businesses and persons that lend money in connection with their trade or business, and in full or partial satisfaction of the debt, the lender acquires an interest in the property that was the security for the debt, or the lender has reason to believe the property was abandoned. So what does that mean in plain English? If you go to a bank or another lender and you borrow money to buy an asset and you don't make the payments on the debt, they can take back the asset because it was security for the loan and keep it or sell it in order to pay off the balance. And so that's what we see in this little example here. We have a bank loans money to Adam so he can buy a motorcycle, and the purchase price of that bike was $15,000, and the bank financed $13,000. Now Adam stopped making payments, and he was in default, so the bank hired a repo company to take the bike back, and they sold it at auction for $8,000. Now Adam owed the bank on the date of repossession $10,500 was the principal owed, and so these are all the amounts that would potentially be reported on a Form 1099-A. Now because Adam owes more than the bank was able to get for the motorcycle, the bank can certainly still chase him for the amounts owed. Or if they decide to forgive all or a portion of the debt, then they would file a 1099-C to report the amount of canceled debts, right? Now, when are lenders absolutely required to file these? So lenders must file these if they know that the person is using the asset for trade or business uses or it's real property. So if we have a lender that lends out funds to buy a personal use asset and it's tangible property, they don't have to do it. So lenders are generally not required to file 1099-A if the property is tangible personal property, so things like a car, boat, computer, motorcycle, other machinery or equipment, a tractor, whatever it might be, and if that asset was being used for personal use only, right? So in this example up here with the local bank, the bank actually wouldn't have to file a 1099-A if Adam was using the motorcycle for personal use reasons, because the motorcycle is a tangible piece of personal property and it's not being used in a trade or business, so there was no filing obligation. But on the other hand, real property always needs to have this filed, right? Regardless of whether it's personal use, investment, used in a trade or business, and so on. All right. Now, where you report the 1099-A on your return depends on the type of asset, what it was being used for, right, and whether you have a gain or loss, right? So, for example, right, with the first one, right, if this was a tangible personal property not being used in a trade or business, in most cases, when that's repossessed, you generate a loss on it, and so you don't report anything on your tax return. And you also don't report anything because losses on the sale or disposition of personal use property are not capital losses. You can't deduct those on your tax return. But in contrast, what if we had a 1099-A issued for real property that was used as a rental? Well, in this case, yeah, you definitely want to report that because it's the disposition of a business use asset, which is reported on 4797. And you have other things to be mindful of, like not only the gain or loss on the sale or the foreclosure, but you might have depreciation recapture, all these other elements that need to be factored in. All right, so let's have a look at the fact pattern, and then we'll take a look at the return and the 1099As. So on January 18, 2021, John buys a single-family home, and it's going to be an investment property, which he wants to flip. Right, so he's not going to rent it out. He's not going to live in it. It's not a vacation home. It's a buy and flip type of investment for him. And now in 2022, he can't find a seller, right? He can't find a seller. Nothing's going right. And he ends up defaulting on the note, and he owes $157,250 in principal when the bank takes the property back. Now, the bank sells the property for $161,000, so it was at a loss. And they applied all of the proceeds against the balance owed of $157,250, right? So the sale proceeds cover the entire debt. Now the excess proceeds from the sale, that $3,750, of that amount the bank kept $2,000 because they wanted to cover the costs related to the foreclosure, the sale, and then it gave the remaining amount, $1,750, to John. So John did get a little bit of cash from the sale, but certainly not much. Now, the Form 1099-A here has to be filed, right? Because this is real property that was repossessed and sold. So the 1099-A is going to be filed by the bank, and it's going to report a couple elements, right? So if we look at the 1099-A here, so we have the lender's name and address is going to go up here with their tax ID number, and then the borrower's name, address, and tax ID. Now, this is for calendar year 2022. We have the date that the lender acquired the property, so September 1st, 2022. A description of the property, so the street address is generally what you're going to see. And then a check mark here in line 5 that John did sign a personal guarantee, so he's personally liable for the debts. Now, the balance outstanding on the date of repossession was $157,250, and then there's the fair market value of the property when it was sold, so $161,000. Now, the property was taken from John, but again, this is a piece of real estate that was an investment, so he needs to figure out whether I have to report this on my return, and do I get a gain or loss on it? And the answer is yeah, you definitely want to report it, and because it's an investment property, it's not personal use property. If you do realize a loss, you can deduct the loss. If you have a gain, you're certainly required to report the gain. So John's cost basis in the property is $185,000. So that's what he paid for it. But now he needs to figure out, well, how much did I realize from this event, right? How much would I record as my quote, sales proceeds? So the realized amount, and we'll have a look at the worksheet next. The realized amount is the lesser of the FMV of the property transferred, or it's the amount of outstanding debt before the property was taken from you, reduced by amounts you still are personally liable for, and then you add any amounts you receive from the foreclosure sale. So let's have a look at the worksheet that John completed. So here's the worksheet that John needed to complete. So part 1, we're only completing this if we're personally liable for the debts, right? And the answer is yes, we are personally liable for the debt. So the fair market value of the property transfer, that was the sale price, $161,000. And so on line 1, we're trying to figure out how much do we enter here, right? So we would enter the amount of debt immediately before the transfer and then lower it by any amounts for which we are still personally liable. In this case, it's $157,250 was the principal amount owed. But we are not liable for anything beyond that because the sale covered the entire balance of the note. So we have $157,250 minus 0. All right, so once that's completed, we move on to figure out the gain or loss from the foreclosure or repossession. So it wants us to enter the smaller of line 1 or line 2, Well, the smaller amount is the $157,250, so we've got that figure there. On line 5, enter any proceeds we received from the foreclosure sale. So in this case, we did get something back. We got $1,750 back. Obviously, in a lot of cases, you don't get anything back, right? But in this case, we did get some cash back. So we add lines 4 and 5. We have our realized or adjusted realized amount of $159,000, so $159,000, and then our adjusted basis of the property. So what John paid for it, $185,000. Now, obviously, if John had made improvements to the property, then he could increase his adjusted basis. But in this case, we're just assuming that he paid $185,000 for it, did no work to it, and so that's his adjusted basis in the property. Now, the gain or loss here, right, from the foreclosure repossession, we would subtract line 7 from line 6. And there we have our $26,000 figure. So this is how John figures out what is his loss on this repossession and foreclosure of the property. So when he looks at his tax return, he would report this on Schedule D and 8949. So if we jump to 8949, this is a long-term disposition, right? So he acquired it on January 18th, 2021. The thing was repossessed and foreclosed on September 1st, 2022. And so we have the description of the property. It was an investment property and the street address. And so we have the proceeds. That's the again, the amount from the worksheet, right? So what is his adjusted proceeds from the sale or foreclosure of the asset? So again, even though he didn't actually sell it himself, and nor did he actually keep any of this money, obviously, except for the $1,750, that is his adjusted realized amount. It's the $159,000. So we have the $159,000 there. His adjusted cost basis was $185,000, and we have a capital loss, long-term capital loss of $26,000. Now, very, very important to remember here. If this is a scenario where we have an investment property, right, real estate investment, if this is a personal use property, you might not be able to take a loss, right? If you sell it at a loss, there might not be a loss at all. Or sorry, if you sell the property at a loss, losses for personal use property not deductible. Maybe the property is foreclosed on, and the realized amount actually realizes a gain for you. So you might have the sale of a principal residence with a gain, and then if you qualify for the principal residence exclusion, you can have those adjustments here. But very important to remember that when you receive these 1099-As, you have to very, very carefully assess, okay, what happened here? What kind of asset is this? Is it personal use property? Was it used in connection with a trade or business? Was it an investment property? A lot of moving pieces to be mindful of. So the short answer here is, again, in a lot of cases you might receive this and you have to do nothing, but in some circumstances, yeah, you certainly need to report some of these elements in addition to others that you'll compute on worksheets such as this to figure out what elements need to be reported on your tax return. All right. Okay, so that covers it for this video. I hope that was helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thank you.